This is Satya Pradyuman of Cirrus Research. The latest quarterly outlook is just out, the dispatch. The title, Barbelled, Mag-7, and Value to Close Strong in 24. What we're really saying here is that the trending characteristics underway in the market, the AI spend, it's hard to see that reverse on the fly. That said, the acceleration in these trends suggests some caution. Part two is that the profit cycle is bottoming. It's not peaking. And as a result, you have a much more cyclical rebound underway. As a result, adding value hedges some of this trending risk that will surface. First of all, the global profit cycle is effectively bottomed. In the last 6-9 months, what you'll see is that whether it's the US, Europe, Asia, what we're seeing is that the profit cycle, the trend line, has been breaking for the last couple of years as a lot of the central bankers had tightened. This is now starting to reverse course. The estimates also suggest over 6-9 months that these estimates have suggested a higher high. The exception to the rule is that in just recent quarter, the Chinese revenue numbers started to bottom. However, the estimates still remain soft. That's probably the exception to the rule here. This sort of stabilization in earnings, or the ability to see earnings grow, is very constructive, but with a more cyclical band. This diagram that we've put together really relates some of the questions we've had in the field, which is, how could we act? How could we be more constructive when you've got the risk of the Fed, you've got inflation? But I think what we need to do is really consider whether you're at the peak of a profit cycle or at the bottom of a profit cycle with Fed action. And so the idea here is that at the peak of a profit cycle, with the Fed coming in to tighten, is really bad for risk assets. Conversely, at the bottom of the profit cycle, while Fed action still throws a monkey wrench in markets, the risk is potentially more about leadership or rotation than it is bad for risk assets. I think this image, though, frames this current period very well. Importantly, why would we say that trending characteristics are likely to run harder? Number one, we've got risk-taking globally that's actually on its heels. So even in the US, with the strong market that we've experienced, notably the large mega cap segment, these risk appetite measures are on the mend. They're not at the high end. We tend to have a higher expected return 6-12 months out when risk appetites have bottomed and are on the mend. Once this crosses over to some extreme, that is really where the tables start to turn. And then finally, a look at, how would we frame where we're at? While we do have a constructive outlook on equity, the trending characteristics here suggest that there's more room for this to run. The risk appetites measure is more of a 9 p.m. sort of event, not a midnight. And the crowding measure is still benign. Part of it is that the leadership stocks we're looking at, they're making money. And so this could potentially stretch leadership for longer. The portfolio recommendations we've had, we've definitely been looking more towards a GARP-based model for growth managers for all the reasons we've walked through. The idea is that you've got earnings growth on the mend, so you want to look at valuations a little bit more because growth is easier to find. And we've also steered away from quality. Not that we really want terrible balance sheets, but the idea is that if the profit cycle is bottoming, why would we pay up for protection? Take a look at the full report, and as always, happy to take your questions. Thank you.